Valens Research, Uniform Financial Analytics.
So what you can see here is where we bring all of our clients on a when they actually look at uniform accounting tools, which is the performance and valuation prime. Right, the performance and valuation prime chart, or PVP chart, again, highlights the fact that we're very literal here at Valens. The reason why we bring everyone here first whenever they look at any company they want to look at is because of the fact that it is a phenomenal level setter for clients. When you look at Henry Schein, what we're looking at here is what are the real returns and asset growth of the business, right? This is the performance of the company. And then what are the real valuations, right? Value relative to assets, value relative to earnings. Think of adjusted PE and adjusted price to book. So that's why it's the performance, right? First two charts, and valuation, second two charts. Why prime? It's prime because of the fact that we're actually looking at the adjusted uniform accounting metrics. So to jump in, you'll notice when we look at the historic bars here from 2004 to 2019, there's two bars. There's the orange bar, and then there's the blue bars. The orange bar is the distorted as reported GAAP accounting metrics for this company, for Henry Schein. On an as reported basis, Henry Schein looks like it's got a 6% ROA that's basically declined since 2016. And from 2007 to 2016, it was actually a more profitable business at around 8%. But after we make all the uniform accounting adjustments and we look at the true blue uniform accounting metrics, what we see is something very, very different. Henry Schein doesn't have declining returns and low returns. It's not basically a cost of capital business. We see Henry Schein as having 27% returns, phenomenally profitable business. And it doesn't just have phenomenally high returns. Returns have dipped in 2017, like as reported metrics reflect, but in reality, since then, they've actually recovered. Returns have expanded since then. Similarly, when we look at asset growth, we can see is, right, first we can see the orange distorted as reported GAAP asset growth for this company. And then we can look at the uniform accounting true blue asset growth, right? What we can see here is the company hasn't just shrunk 1 year in 2019, it actually shrunk both of the last 2 years. It wasn't growing in 2018. You literally would look at this company on an as reported basis and think you had a low return business that just finally started shrinking. What we see is a high return company that's been rationalizing its business profile for the last 2+ years. It understood what it had to do after returns dipped in 2017 and management acted quickly. And now it's a really high return business. Similarly, we look at price to book, at traditional as reported price to book versus our uniform accounting price to book. And what we can see here is there's a very strong relationship between a company's price relative to its book assets, our value to asset prime ratio, and how profitable the company is. Companies that tend to have higher returns get higher multiples relative to book assets. If you think about it just intuitively, our uniform accounting real cost of capital is around 5%. So if a company's return on assets is around 5%, intuitively that company should trade at roughly 1x book. On the other hand, if that company can generate a return 3 times what its required rate of return is at 5%, at 15%, that company should trade at 3 times its price to book. Unsurprisingly, for Henry Schein, right, cost of capital is around 4.8%. It is generating around a 25% return on average over the last few years. It's trading at a 5 times price to book. The reason why we look at a price to book is it can help us give a quick litmus to understand, is the company overvalued or undervalued based on how profitable it is. Similarly, we look at our as reported and uniform accounting adjusted PE. We call it value to earnings prime ratio, but it really is a cleaned up adjusted PE. The reason why we look at this, just like any PE analysis, 1, we want to understand what the multiple the market's paying for the company. 2, we want to understand historically what's the kind of multiple the market has paid for the company, so we can understand, is it expensive or cheap relative to history, and also is it relative cheap or expensive on an absolute basis. The last chart here is TSR. For those of you who don't know what TSR is total shareholder return. It is the easiest way to explain it is the total income that an investor expects to get from the company between dividend income and capital appreciation any given year, right? So it's what the company actually produced for investors that year in terms of both dividends paid out and capital appreciation. The R here, the little smaller second R, is relative. Relative to what? Relative to the relevant index for the company. In this case, the S&P 500, since this is a US-based company. When this slopes up, that means the company outperformed the market. When this is flat, it means the company performed in line with the market. When it slopes down, that means the company underperformed the market. What's really interesting is normally we see a very strong relationship between this metric here and what the real uniform accounting metrics show. In a way, we see no relationship with the as reported metrics. Just looking here, look at how as ROA grew and the company was reinvesting in the business, TSR rose, right? This company outperformed the market by 3 times over that 10-year period. Why? Because returns weren't flat, its returns were growing, and it also had growth in the business. Since then, right, in 2017, obviously, TSR dropped. Why? Returns dropped. And then TSR has been sideways. Why? Because while returns have recovered, they've recovered because the company is shrinking. You can see the as reported metrics do not actually relate to economic reality for this business and how the market looks at the business, but the uniform accounting metrics do, as we can see with TSRR. So you notice I only focused on the historic columns here previously. Now let's talk about what the light blue and the white bars mean. The light blue bars are focused on what are sell-side Wall Street analyst expectations for return on assets once we convert those estimates into a uniform accounting basis for the next 2 years. For Henry Schein, we can see that returns are expected to rise. They dip in 2020 and then they're projected to rise in 2021, back above even levels seen in 2019. The white bars, that is what the market is pricing in at a $10 billion market cap and a $70 stock price for the company. We focus first and foremost always not on understanding what we think the company is worth. Our focus always is focused on what we call embedded expectations, understanding what the market thinks a company can do, right? Because if we can understand that, like great investors from Bill Miller to Seth Klarman to Einhorn, et cetera, focus in on, which is understanding first, what does the market expect before you bring up your own opinion on a company, we can better understand if we even need to spend time on a company. And so we look at this for both an ROA and an asset growth basis, right? You can see asset growth is basically flat, forecast to be flat here. But what the market's pricing in is this company that really on average for the last 5 years hasn't grown, is going to continue to not grow, with returns plateauing at levels around 2019 levels. That actually looks really reasonable. It also tells us the market isn't paying attention to the garbage in, garbage out as reported GAAP metrics. It's looking at our adjusted metrics because it understands that that's what the business has been going through. Now, what we can do is we can actually play with scenarios using what we call the embedded expectation analysis to figure out if we think the company could do different things from this, whether it could be worth something or not. You know, we talked about the last 2 years the company shrunk. Before that, it grew at an average of, call it 5 to 10% a year. So let's say that I think that the company could grow at 5% a year going forward. What does return on assets have to be to justify current stock price if it can grow at 5% a year? If the company can grow and returns fell as it grew to 22%, a little above where they were in 2017, the company would be fairly valued. If the company could grow and keep returns stable though, what might this company be worth? I guess 20 to 40%, I actually don't know, but we can see because we can actually do this analysis, plug in our scenarios, and solve for the stock price to say, what would this company be worth if we do that? If that happened, the company would be worth around 35% more than it is right now, $90 instead of $70. But the really powerful thing about uniform accounting is twofold. One, it actually changed the way that we thought about this company to tell us, no, it's probably reasonable this company is just not going to grow, might even shrink. But also we understood it's a far more profitable company than as reported metrics make it look like. That's the first thing we understood. The second thing we understood is we could quickly do scenario analysis to tell us, now that we understand the true nature of this company, is it compelling enough for us to actually look at? And the answer is probably no.
Valens Research, the world's leading source for uniform financial analytics.